Welcome to the final section of the ASC 480 series. Classification and measurement are behind us. Now we cover what appears in the published financial statements, what disclosures the standard requires, the most common mistakes teams make in practice, what auditors look for, the control environment around these instruments, and the period-end checklist that keeps everything on track. After this section, you will be able to correctly present every ASC 480 instrument on the balance sheet and income statement. You will know what the standard requires in the notes. You will recognize the 6 mistakes that appear most frequently in practice and know how to prevent each one. You will understand what auditors expect to see in workpapers for ASC 480 instruments, and you will be able to use the period-end checklist to verify compliance before sign-off. Presentation is where the classification decisions become visible to financial statement users. Mandatorily redeemable preferred stock and all other instruments meeting the 3 liability categories belong in the Liabilities section, typically as separate labeled line items. They do not appear anywhere in stockholders' equity. Dividends on these instruments appear as interest expense on the income statement, not as a deduction from equity. Mezzanine equity instruments, those redeemable upon uncertain events outside the entity's control, belong in their own separate section between the Liabilities section and the Permanent Stockholders' Equity section. They are not part of either zone, and equity-classified instruments that satisfy fixed for fixed go in stockholders' equity with no subsequent fair value remeasurement. The income statement presentation rule is worth repeating one more time because it is violated so often. Dividends on any instrument classified as a liability under a ASC 480 are interest expense. They reduce net income. They are not a deduction from retained earnings. They are not presented below the line. They go in the same category as interest on debt. And fair value changes on liability-classified instruments also go through the income statement, not into other comprehensive income. There is no OCI option for a ASC 480 instruments. Once you know the classification, the income statement placement follows directly from it. ASC 480 requires entities to provide sufficient note disclosure for users to understand the classification, terms, and financial impact of every instrument in scope. The core disclosure requirements are the nature and terms of each liability-classified instrument, including redemption features, conversion features, and liquidation preferences. The classification rationale, an explanation of why an instrument that appears to be equity is actually classified as a liability. The redemption schedule, amounts due and the years in which they are due, and the fair value measurement methodology and significant assumptions for every instrument measured at fair value. The disclosure requirements also include changes in the carrying amount of each class of instrument during the period. This lets users understand how these liabilities evolved. For public companies presenting mezzanine equity, disclosure must include the aggregate carrying amount, liquidation preferences, and the redemption features that drove mezzanine presentation. A key practical point: incomplete or missing disclosures are one of the most frequent findings in ASC 480 reviews. Teams often complete the balance sheet presentation correctly, but then do not build out the note disclosure to the required level of detail. Both the presentation and the disclosure are required. One without the other is not sufficient. 6 mistakes come up repeatedly in a ASC 480 practice. First, the default assumption that shares equal equity. Every arrangement involving the entity's own shares needs the dollar versus share question answered before any classification decision is made. Second, recording the initial liability for a written put or forward contract, and then not remeasuring it to fair value at subsequent period ends. The standard requires remeasurement every period. Third, treating all preferred stock as equity because it looks like equity and was previously called equity. Check the terms, every time. Mistakes 4 through 6. Mistake 4. public companies that combine all preferred stock into permanent stockholders' equity without assessing which instruments belong in the mezzanine section. Redeemable preferred stock that is not a liability under a SC 480 but is redeemable outside the entity's control requires separate mezzanine presentation. Mistake 5. Recording dividends on liability-classified preferred stock as equity distributions, reducing retained earnings rather than recognizing interest expense. This distorts both the income statement and equity. Mistake 6. Applying the IFRS split accounting model, bifurcating convertible debt into a debt component and an equity component on a U.S. GAAP engagement. Post ASU 2020-06, this model does not apply to most U.S. GAAP convertibles. The error typically comes from IFRS-trained team members applying their default approach without checking U.S. GAAP treatment. When auditors review a SC 480 instruments, they expect a complete and organized workpaper file. The starting point is a comprehensive list of all financial instruments involving the entity's own equity, with a classification memo for each instrument documenting the analysis and the conclusion. For mandatorily redeemable instruments, they expect the certificate of designation or governing agreement as evidence that redemption is mandatory, plus documentation that the trigger is certain. For instruments measured at fair value, they expect the valuation methodology, the key inputs, and if the amounts are material, independent valuation or model documentation. For mezzanine equity, they expect documentation of why the redemption trigger is not certain enough for a SC 480 liability, but is outside the entity's control enough to prevent permanent equity classification. The control environment for a SC 480 instruments follows the standard three-tier review structure. Team members perform initial identification and classification of all instruments, record transactions, prepare supporting schedules, and critically, escalate any unusual items, borderline classifications, or judgment-intensive conclusions to the team lead immediately. Do not resolve judgment calls alone at the team member level. Team leads review all classifications, all journal entries, and all disclosure drafts before they move forward. Managers approve all judgment-based conclusions, significant estimates, and client communications about material accounting decisions. No material a SC 480 judgment call is finalized below the manager level. The period-end checklist covers 4 categories. Identification. Confirm all new instruments involving own equity have been reviewed against a SC 480. All 3 liability categories have been assessed, and any judgment-intensive conclusions have been approved by the manager. Measurement. Confirm all written put options and forward contracts have been remeasured to fair value. Fair value changes have been recorded through the income statement, and mandatorily redeemable instruments have been accreted toward their redemption values. Presentation. Confirm liability classified instruments are in the liabilities section. Mezzanine equity is in its own separate section, and no mixing of classification zones has occurred. Disclosures. Confirm the classification rationale is documented in the notes, the redemption schedule is complete, and the fair value measurement methodology is described. All 4 categories must be complete before sign-off. This section brings together the end-to-end compliance picture for a SC 480. Presentation is a direct output of classification. The standard does not give preparers flexibility on where instruments appear. Dividends on liability-classified instruments are always interest expense, no exceptions. The 6 common mistakes are all preventable if teams ask the right default questions and maintain discipline in the review process. Auditors expect a well-organized workpaper file with documented reasoning for every classification decision, and the 4-category checklist: identification, measurement, presentation, disclosures, is the final gate before any period-end sign-off involving a SC 480 instruments. Thank you for completing the full SC 480 Distinguishing Liabilities from Equity training series produced by PNJ Group. Thank you for watching. Subscribe for more training from PNJ Group.